Hi everyone, and welcome to our Facebook Live Q&A with our financial services team, Sean Kavanagh and Paul Condon. Over the last couple of days and last week, we've asked you to send in some questions that you might have in relation to mortgage related or anything in relation to maybe buying a property or life insurance or anything like that. So we're going to kick off here. Mairead has sent in the first question. What's the difference, and is it more expensive to use a mortgage broker instead of going to the bank directly?
Not at all. Basically, we don't charge up front for our fees. The banks pay us commission a month after you move into the house. Interest rates are the same, regardless of whether you go to the bank or to us. The advantage with us is we've got a wealth of expertise, Ray, and you know yourself. And as I say, we can deal with the banks. The banks come into us, into our office. You don't have to go to 3 or 4 or 5 banks yourself. We do all that for you.
A lot of times people only ever go to one bank themselves, anyway.
Yeah. I mean, the whole point of dealing with a broker, in fairness, is to shop around and make sure you're getting good value for money. So a broker will be able to compare the banks between each other. So you walk into AIB or you walk into Permanent TSB, they can only tell you what they can give you themselves. They can't do a comparison to what their competitors, KBC or whoever else is offering. So we can do that. So and typically some brokers charge fees. Again, as Paul said, we don't charge a fee for the work that we do. We're paid by the lenders at the end of the day. So it does actually work out cheaper in the long run by going with a broker, in our opinion.
Okay. So the difference is it's cost effective, and it's going to be, we're more likely going to be to shop around. A broker is going to be more likely going to shop around and get a better deal, more than likely than the bank. Yeah,
it's putting more options on the table.
Yeah.
So I mean, if one bank, and criteria can change as well. So if something changes in 2 weeks, 3 weeks, you don't have to restart your application again. If you have multiple options available, that's what we do. We always have a plan A and a plan B.
Okay, great stuff. Roisin has the next question in. Typically, how much can I get approved for?
It depends. That's a big question, I suppose. Income is taken into consideration, how many children you have, how many incomes are there if there's 2 people applying, if you have car loans. So there's a lot of factors in there. As a very, very rough rule of thumb, you're talking 3.5 times your gross salary. Okay. So if you earn 50,000 or 100,000 between you, you're multiple of 3.5 times. But that does depend. If you have 4 kids and 2 car loans, you may not get that. So the best thing to do is to sit with your mortgage advisor and maybe, whether it be a bank or a broker, and ascertain your budget before you start out through the process.
Okay, great stuff. Thank you, Roisin. John has the next question in. How long does it take, 2 questions, how long does it take to get mortgage approval, and how long does it last? Paul, maybe you can answer that.
Right, yeah, okay. First question, once we've got all information off you to give to the bank, they'll have it turned around within 4 to 7 working days, say around a week.
Great.
And then most of the banks, and then most of the banks will hold that for six months.
6 months,
6 to 12. Markets change, of course. So
yeah. So it's around 6 months definitely, and there is some banks doing 12 at the moment.
That's right, yeah.
But that could change. It's always going to be 6 months.
That's right, and even then, if you go a couple of months past that, it's usually just a couple of pay slips and a month's bank statements just to refresh that.
Just on that, what we would recommend is that if you can get all your paperwork together at the beginning, because what tends to delay things is that if the lender has to come back and ask multiple questions, so can they clarify this and this, or request additional bank statements or something else, that will slow the decision down. So we normally sit with you and give you a full checklist of everything that we need and say this will cover, and if you have all that in day one, we will have the decision again within 4 to 6 months.
And that leads into the next question from Claire. What documentation do I need to get a mortgage?
Yeah. It's usually a summary of your income and outgoings is what the lender is looking for. They want to obviously confirm that your income, so they want to see pay slips. They'll want to see a P60, what you earned last year. They'll want to see a certificate from your employer to confirm that you're permanent, or if you're on contract, what the nature of that is. They want to see how you're managing finances, so your bank statements there, so how you're managing what you're saving, what loans you have, if you've any unpaid in your bank account. So all these things they want to check out.
So to sum up, you're talking about pay slips, bank statements. So if you have a savings account with your credit union, you need that.
You need that statement. So
are we talking about 6 months, 12 months?
Usually 6 months.
Yeah.
6 months.
And then, sure, nowadays everyone really has online accounts.
It's anyway. Online. You can send them across.
You can just scan them across to us and everything like that. Obviously, people won't need to get worried. They can obviously contact you. You'll give them a list of what you need as well, exactly. And then they can just tick it off.
We do that at the first meeting. We'll tell you this is exactly what I need, and once we have everything, we're in the position then to take it to the banks and see what options are available.
Okay, great. Alright, this is another question in from Magda. How much savings do I need before applying for a mortgage, and how does the deposit work?
Okay, Magda, if you're a first time buyer, the minimum deposit's 10%. So, for example, a house or an apartment worth 250,000, your deposit for a first-time buyer is 25,000.
Yeah.
Plus solicitors' fees and stamp duty will allow around 5,000 for that as well.
Okay.
If you're next-time buyer, or you're 20%. So
okay.
In this case,
so a second-time buyer or trading up or whatever, yeah.
That's right. Yeah.
And again, if you're working off the 250, you need a 50,000 deposit there.
That's right. Yeah.
And Sean, how does the deposit work?
Well, usually when you go sale agreed, so if you make an offer and your offer is accepted, you'll be asked to put down a booking deposit. So again, using the same example, this €25,000 that you've is your booking is your end. The bank will cover the rest. Usually you pay a booking deposit of €5,000.
Yeah.
That's given to the estate agent. That takes the property off the market, and then usually 3 or 4 weeks later you'll meet with your solicitor, and then you'll pay the balance of the 20,000. Then that's when you sign contracts, and then effectively at that stage you formally bought the house.
That's a non-refundable deposit.
That's non-refundable. So again, you want to make sure your loan offer's in place, you have all your surveys, everything done, and everything's watertight by that stage.
Perfect.
Because when you're signing, you're surrendering that money and it's non-refundable.
Yeah. Okay. Well, their solicitor will go through that.
Solicitor will do all that for you. Yeah.
This is a question from Paul. Hopefully it's not you,
Oh,
Paul.
I know what I'm doing right.
Hopefully you know the answer to this. How long do I have to be in my job before applying for the mortgage?
Typically 6 months, or the banks like to see you being in a permanent position, i.e. passing probation.
Okay.
And they usually need to see probably 3 years employment history as well.
Okay.
That's for PAYE. If you work for yourself or you're self-employed,
2 years. Yeah.
it's probably close to 2 years. They want to have 1 year compared to make sure, which seems a little bit unfair, but unfortunately that's just the way it is.
Yeah, there's bigger risk as well.
There's bigger risk involved with someone who's self-employed, but for someone who's PAYE, typically you want to be in the same role for a minimum 6 months, because usually that's carries the probation.
So someone employed needs minimum 6 months.
Usually minimum 6 months.
Okay. This is one in from Melissa. Are all the banks the same?
Absolutely.
I presume, I don't know what she means by that. Maybe she means the rates, is it? Or,
or
to deal with it?
There's huge differences. There's massive differences between banks. Interest rates, there's more than 1% in the difference between the highest variable rate and the lowest variable rate. Now, over 20 or 30 years in a mortgage, that could be 30 or 40 grand of the saving, just on the interest rate alone. Different banks look at.
Well, it's important to shop around, obviously, as well.
Exactly. By shopping around the banks, obviously we'll
go back to our previous
point. The other way they're different is that they take income into consideration. So if you get paid overtime or bonuses, the treatment of income is actually different. So some banks are actually better at taking overtime, bonuses, extra income, and they'll use that into the multiple of 3.5 times, where other lenders would be a bit more conservative. So it's not unusual to go to 4 or 5 different banks with the same information and get very, very different figures, particularly if there's an investment in the background. If there's an investment property, I've seen it personally, nearly 100,000 the difference between what Bank A will give and what Bank B will give. So it really depends. So they're not.
If you're a typical first-time buyer going in, obviously, like I said, it depends what job, how they're earning money. If it's grand, if they're on a flat wage and they're earning 35 grand, 40 grand a year. Yeah. But obviously, if they're earning 20 grand and 20 grand commission, it's a different story. All the banks will look at that differently.
They'll all assess that differently. So again, that's where by shopping around and looking at a broker rather than going individually with the banks, because if you walk into, again, one lender, particularly your own bank, they'll tell you what they can lend, but they actually can't tell you what someone else will do, which is obviously why we.
So again, shop around and you can do that work for them. Yeah. Okay. I'm paying. Sorry, this is a question from Julie. I'm paying rent at the moment. Is this taken into consideration when applying for a mortgage?
It is, Julie, purely for repayment capacity. The bank needs to see that you can actually afford the mortgage repayments, and what they do is stress test plus 2%. So what the banks like to see with your rent is that your rent coming through the bank accounts. Cash is no good unless
prove that they're paying it.
That's right. Yeah.
Okay.
It can't be used obviously for the deposit, which we if we could go back to where the 100% mortgage or 95% mortgage back in the day, a lot of people are struggling to save and rent at the same time, and especially in this market. But it definitely will be used once they can evidence that through your bank account. So it's very, very important to have your rent coming out of your bank account, because if you're paying it cash, the lender has no way of actually proving that you can actually afford the mortgage that you're applying for. So
okay. And when you say repayment capacity, that means you have to just prove to the bank. So again, if you're talking about that 250,000 mortgage, let's say your mortgage is probably around about 900 quid a month. So you have to be either say, and then the bank are going to stress test you by another 2% on the interest rate. So you need to be really saving. If your mortgage is be 900 quid a month, you need to be probably saving 1,100 a month.
That'd be fair. I mean, just to explain the stress test, the lender doesn't want to approve someone today that may not qualify if the rates change in 6 months' time or a year's time. So if interest rates increase, you may not qualify for that loan anymore. So they actually apply a stress test. So they'll assume the interest rate is higher than actually
the interest rate is a lot higher than
it is, and if the repayment goes, so you can afford, and it's basically down to you to show them you can do that.
And then if you were paying rent, and let's just say your rent was 1,500 quid, and your mortgage was only going to be 1,100 quid, do you need to save any money then?
The more you can save, the better it looks to show that you're managing, because if the car breaks down or you need to replace your washing machine, that you're not overdrawn that month. You've a little bit of
so always be saving even a couple of hundred quid on top of your rent.
Save as much as you can. The more you save, the better it will look.
Yeah, because the bank look at everything really. Okay. Yeah. Great. Okay, this is from Sarah. My parents are helping me with my deposit. Is this okay?
Yeah, no problem. Like we just touched on there, you need to be saving probably half the deposit yourself, and the parents can chip in then as well. What we do initially is get your parents to fill out a gift letter that will go with the application. Okay. Then moving forward, the money goes into the account at a later stage.
Okay.
Yeah.
Bank and mum and dad are kind of financially rolling the industry at the moment, I suppose. But it's if you're getting a substantial gift, if there's a lot of money coming in, certain lenders do have criteria that you have to have a certain minimum saved yourself. Not all banks, but some banks do. So if one bank says no again, someone else might say yes. So that's where we'd sit in and talk to a few there for you. But it's probably even more important that if you're getting a large gift in the deposit, that you can show that you can save other ways. So if you have been previously renting in the last maybe 6 months, get the previous 6 months bank statements so you can show the rent on it, especially if you're getting the gift handed to you, because you need to be able to prove to the bank that you can afford this in your own right.
Okay, great. Question in from Adam. What is the difference between a fixed and a variable rate, and which one is the best one to go on?
Yeah, well, the difference between a fixed and a variable rate is one is fixed, so if you choose to fix your rate for 3 years, your rate and your repayment will not change for the 3 years. It's locked in, so if interest rates go up or they go down, your interest rate and your repayment won't change. That's the nature of a fixed rate. A variable rate, it is subject to change, so it can increase. Now, it's not like the stock market, they don't go up and down every day, but typically the rates will change a couple of times in the year. So which is the best one? It depends. There isn't a right answer. Some people like the certainty of it, being able to budget and say, well, I know what my payment's going to be for the next 2 years or 3 years, so I can budget my ESB, my bills, my whatever, my bills, whatever that's there. Some people like the idea of saying, okay, well, if I'm variable, I can pay a little bit more, or they think the interest rates are going to come down a little bit. Plus, if you're on a variable rate, you can actually overpay your mortgage, so you can actually pay more. So if you get regular bonuses or commission, and you don't want to have a mortgage over 30 years or 35 years, you can pay extra into it, and there's no restrictions on a variable rate, which sometimes there is with a fixed rate.
So I remember having a client there as well years ago, and he always got his bonus in the second half of the year, and then he was always on the variable rate, and then he'd be able to lump some money off his mortgage there as well, so he'd always have an extra couple of thousand that he didn't want to spend, and he put into the mortgage as well. So obviously if you're fixed, you can't really do that, so I know it's different, but like I said, it's obviously variable. That's a good thing. Okay, which one is the best?
I don't think there is a right answer. It really depends on what everyone's
personal choice.
Personal choice. The majority of the market at the moment tends to be fixing. At the minute, fixed rates is probably good fixed deals out there, because the bank is buying its money in for so cheap. They can afford to lend at low fixed rates. So people.
And are interest rates going to go down any lower, do we think?
We
don't have a crystal ball.
Yeah, it's impossible to see. The cost of funds, the ECB is at 0% at the moment. Up until last year, there was talk of interest rate increases this year. I think maybe things are going to stay where they are. There might be some slight. It depends. If one lender reacts and brings down their interest rate, usually they all tend to follow suit. So,
or if more competition comes in, more banks come in or whatever. Okay.
I suppose if you're worried about that, you can lock in for a fixed rate for up to 10 years. If that's
another thing a lot of people don't realise here as well, you can actually take a fixed and a variable rate with your mortgage. So if you're borrowing 225,000, you could have 200 of that fixed or 150 fixed and the rest of it variable. So if interest rates do increase or decrease,
that rate that's fixed is...
It's only that portion that's increasing and decreasing, so you can actually hedge your bets if you want.
Okay. This is a question from Jenny. When should I apply for my mortgage, or apply for our mortgage?
I think, Jenny, talk to us first, and if you're not ready, as I say, we'll guide you through the process to get your mortgage ready. Most of the banks look for a 6 month savings history. But look, we'll get you on the right track and talk first.
Personally speaking, I would rather sit down with somebody between 3 and 6 months before they're considering buying. So just to make sure they're saving enough money, and again, if there's anything in the bank accounts that shouldn't be there, so if there's a loan finishing off or they're using an overdraft regularly that they shouldn't be using, so just maybe do less of this and maybe save a bit more. So when we make the application in 3 to 6 months, the accounts look healthier, everything's okay, and then the application will go through quicker on that.
Yeah. So basically speak to you before they look at any houses?
Yeah. Establish your budget. There's no point looking at houses for 300, 400, 500,000 if you're nowhere in that bracket.
Yeah.
So come in, establish your budget, see, have a chat about that, and then go away, and we'll give you a plan in place so you can set that out, and then we'll pick up where we left off in 3 to 6 months after that when you're ready to go ahead.
Okay, this is in from Column. Is it possible to get more than 3.5 times my salary or my income?
It is. What you're referring to there, Colin, is a central bank exception or a central bank exemption. Typically, the central bank made a ruling a couple of years ago that people should be borrowing 3.5 times, and the bank needs to impose that. They're allowed to say break that rule 20% of the time, but that means 80% of the time when people apply for mortgages, they have to impose the 3.5 times rule. So, what determines who gets an exception or who can borrow more than 3.5 times? A number of factors. Usually, if the banks have them available, by June or July, they'd probably give most of them away at this stage.
It's case by case, though, is it?
It is a case.
Yeah.
There's stricter criteria in play for the exception, but that's why we deal with different banks. We can shop around. If one bank doesn't have them, we can go to somebody else and have a chat with them instead. And
that's why people are frustrated. I think they're going into a certain bank and they're getting an exception, and then if they walked in tomorrow, they won't get it off the same bank.
Yeah.
And that's it. There's no
some
consistency,
banks,
really.
Some banks will want you to have a property in mind, and your exception is based on that specific property. So if that doesn't go ahead, and you move to a different property, you lose your exception. So that's just something to take into consideration.
Yeah. So again, shop around.
But it is available. But obviously, contact was there. As I said, yeah.
Okay. This is a question from Mary. I'm considering selling my house and already have a mortgage. Can I transfer this mortgage onto a new property? Paul?
No, you've got to sort of clear that mortgage with the sale, and then we'll work through the new mortgage with
you.
So
they need to get a new mortgage?
That's right. Yeah, there'll be 20% deposit.
Just be mindful that a lot of people back in the day got higher mortgages than they would have qualified in the last maybe 5 years. So particularly in the Celtic Tiger and the boom and everything else. Yeah. So lending criteria has changed. So if you're considering, don't assume that you'll get the same loan as you have today. So it's worthwhile sitting down and making sure if you're selling that the same mortgage is available again to you. But we can ascertain that.
Again, talk to us at the very beginning before you pick a house.
Exactly.
Okay. Yeah. Kieran has sent this one in. Does the government help to buy scheme only apply to brand new properties?
Yes. That's it.
Simple as.
Yes. If you're building a house, it also applies then. So if
you're building a house yourself, obviously you have to site and you're building your own house.
You qualify. You can qualify on that basis, but unfortunately, at the moment, we'd love it to be available for second-hand homes as well, but it doesn't. You have to be owning a brand new house to get.
And that's ending this year as well.
It's
31st of December this year. That's due to.
Hopefully, it's extended, but at the moment, there's been no.
It's not looking likely that it is. Yeah, so that's gonna. So to help to buy, if you're looking at buying something now, it'd probably be buying something now in the next couple of months, so you're in there before Christmas. Okay. This is one in from Jason. My partner previously owned a house, but I'm a first-time buyer. Does this affect our mortgage? So again, I think she's talking about the deposit there.
Yeah. Unfortunately, if to be classed as a first-time buyer, both parties have to be first-time buyers. So you might fall into that 20% rule where you need a 20% deposit, because if one person is a second-time buyer and one is a first-time buyer. If it's a joint application, you might find that you need a 20% deposit. This is where the exceptions are brought in or supposed to be used, where you may be able to get an exception. It's called a loan to value exception. By shopping around and maybe speaking to a couple of lenders there, we may be able to get that for you. So if that is the case, something interesting, do let us know. Okay,
Mohammed has sent this one in. Can I get a mortgage for a property to rent out? So basically, can I get an investment mortgage?
Yeah. There's several. Not all lenders are offering investment finance, but there is criteria in play. There's terms and conditions, but they'll assess how much of a mortgage you have presently, and obviously what you're looking to buy and what the rental income is likely to be. But you can. Yeah.
Come and talk to us.
Okay. And the last question, guys. Maria has sent this one in. Do I need to buy mortgage protection and/or life assurance when getting a mortgage?
Generally, yes, you do. Mortgage protection is a type of life insurance. We could probably do a whole other Q&A session based on the difference between mortgage protection and life insurance.
So what's the difference, as in, because I think this is what people don't have a clue about. They just give me whatever and whatever's the cheapest, and let's move on.
Yeah, basically mortgage protection is the cheapest usually, but normally there isn't much of a difference between a mortgage protection plan and, let's say, it's a standard life insurance plan. A mortgage protection plan basically, it reduces in line with the balance of your mortgage. So if you're borrowing
so let's say the 250 grand, the 250,000 house again.
Yeah, so you're buying at 250, you're borrowing 225, you put 25 of your own cash in. Your mortgage in 10 years' time is not going to be 225, it's going to come down.
As you're paying it off 10 years. So let's just say it was 150 grand in 10 years' time, you owed 150,000.
Exactly.
And you, God forbid, you drop dead.
If you have a mortgage protection policy, basically your cover has dropped with the balance, effectively.
So your 150,000 mortgage is paid off.
It's used to clear off that.
Whereas if you what about extra money on top of that?
No.
So it just pays off your
mortgage. That's what mortgage protection
does. Exactly what it says.
Exactly what it says in the tin. That's it. If you
have
life
insurance,
that can stay level. So if something happened, you using the same example, if there's only 150k there and your initial cover was 225, there's 75 grand there left to a dependent or.
So you're still insured for the 225.
You're still insured for the 225 at all times during that.
Okay.
So, and there might be only difference of maybe €3 or €4 in the difference between both of those plans.
Yeah. So there's no obviously. So if I was putting a gun to your head now and there was a client standing in front of you, or I was your client, what would you tell me to do?
Well, the more you can spend on life insurance, generally the better policy you'll get.
Okay.
So you go for the slightly higher premium.
And the other thing as well is something there that we come across as well is if most first-time buyers coming in, they're only living in a house for 3 or 5 years. So if they get a mortgage protection policy and then sell that apartment or sell that smaller house to trade up, they have to cancel that life insurance
usually
policy.
The mortgage protection
policy. The mortgage protection
the mortgage protection policy will normally die with the mortgage, so you have to reapply for cover again. And people's circumstances can change, so obviously you might not be
I know my back isn't the same as it was 10 years ago.
You might struggle getting life cover a little bit later on, whereas if you took the standard policy rather than the reducing one, you can just bring it with you. And it's set at the price.
So you own the life insurance you have a 250,000 life policy. Whether you own the house or you don't own the house, if you sell the house and you still own that life insurance policy,
and you can bring
you can bring that with you until you're whatever age it is.
Sure.
Okay. Sure. Well, look, that's all the questions there, guys. Really appreciate you taking the time to send them in. Hopefully that you're informed a little bit after that. If you have any other questions, don't be afraid to send us in a message or contact us in any of the 4 offices there as well. The guys here will be absolutely delighted to talk to you. And again, appreciate everything. Thanks very much.
Thank you.
Cheers.